By the time you've watched this video, the Fed has already announced whether they're going to raise rates and possibly if we're in a recession or not. In the first quarter of this year, the economy contracted at, I think, about 1.6% rate. The technical definition of a recession is 2 quarters in a row of negative GDP growth, okay? So they announced this week that there's negative growth. Technically, we're in a recession. Now, of course, the White House has come out and said, not necessarily true. And I don't blame them. We have twice as many job openings as people looking for jobs. We have still historical low unemployment rate. So it's kind of hard to buy into that. However, consumer confidence is lagging. Consumer spending is not going well. And with consumer confidence and sentiment, that could lead to future consumer drops in spending. Now, why is that a concern? Well, GDP is 70% consumer spending. So why do I bring this up? Guys, I made this video before the Fed announced because I want to reiterate over and over that I don't care what the Fed says. Guys, you've probably lived through some recession. We all lived through COVID, right? And a lot of you who've watched probably lived through several recessions over the last 20 years because our average viewer is under the age of 50. So they've lived through recessions. And guess what? Your life is still better now than it was 20 years ago after the dot-com crash and the 9/11 recession, all that stuff happened, okay? Your life will still end up being better if you have a long-term outlook. What is the key there? Live within your means, save your money, don't overspend. Very simple, okay? Even in the worst of worst recessions, you're more than likely going to have a job. The nationwide unemployment rate at the worst time in 2008, 2009 was 10.5% or so. But for college-educated people over the age of 25, it was like 5%. So the vast majority of our viewers are college-educated over the age of 25. So if you're watching this right now and that falls into you, I'm not saying, oh, don't worry about things. I'm just saying you can afford to be cautious, but not stay up at night, okay? All the time worrying what's going to happen. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to take out all the BS news, all the day-to-day news in the market, and say, what am I really focused on from a long-term perspective? From a long-term perspective, the U.S. economy will be bigger and better 20 years from now than it is today. Your job is to invest for 10, 20, 30, 40, 50 years from now. It is not to invest for today. So if you're not here to invest for today, don't worry about the news today. Don't worry about the Fed if they raise rates 1%, 100 basis points in the next 2 days by the time this videos come out. That is not what matters. What matters for you is to make sure you live well below your means, you save up your money, and you dollar cost average in a low cost index funds. And if you choose to buy individual stocks, learn a process like we've been teaching the last 1,700 videos to understand how to buy stocks at a good price. There's a lot of videos out there on YouTube talking about this great wealth transfer. I think it's just clickbait. Guys, what I'm trying to teach you at the end of the day is if you really want to take advantage of a bull market in the future, you have to buy at all times. And here's why. Let's look at this chart right here. Since January 4th, 1999 to December 31st, 2018, if you were fully invested in the S&P 500 and you just waited there, that doesn't even include dollar cost averaging, you would have made 5.62% a year. If you missed the 10 best days, your return dropped to 2%. If you missed the 20 best days, you've actually lost money. So losing the 20 best days, you end up losing money in that time. It's going to be impossible, absolutely impossible for you to time the market. If you miss the 60 best days, and guys, keep in mind, this is 20 years. 20 years has roughly 2,600 trading days. If you miss the best 60 of them, that is 3% of them, not even 3% of them, 2.5% of them, you lost 7.4% per year. $10,000 became $2,100. Now, you might sit there and say, well, Paul, you're staying out of the market for a long period of time. Absolutely. But there's multiple reasons for that. I have businesses upstairs. I have a value approach that I feel confident with that I'm okay doing. But for the vast majority of people, for the vast majority of their money, you need a dollar cost average and stay in the market. It is impossible to time the market. If you want the great wealth transfer that everybody talks about, you must stay in the market and dollar cost average. We don't know what will happen in the future. There's a saying, what matters is time in the market, not timing the market. Okay? You need to stay in, you need to stay invested at all times and dollar cost average as things go down. Can it be tough? Absolutely. But that's why I encourage you to subscribe to this channel, because when things are bad, our views go up because we're the Solace at the end of the day, we're the ones explaining how things will be better. So does that mean I think the stocks are at a great price right now? Absolutely not. I believe we're at the worst times in history. We're even about the level of January 4th, 1999. So stocks have a long way to go down, but I don't know how it'll go down, when it'll go down, anything like that. What matters is you dollar cost average every single month and don't even pay attention to what's happening. Dollar cost average. Now, if you want to go learn about individual stocks and a process to pick so you can put some money towards that, I love it. That's what I did 20 years ago, and now I've become so good at it that I just only pick individual stocks for myself. And there is a process to do that, but you need a value-oriented process. And a big part of that is doing what I just described right now. Put away all the noise in the market. I don't care if the Fed raises rates 3% tomorrow. It doesn't matter to me. Or by the time you watch this video, it's already happened. It won't affect me one bit because I believe that I want stocks to fall so I can buy great stocks at great prices. If you love what I said so far and you like this approach, I'm going to talk about a personal business that I own, one of my 8 or 9 upstairs. It's called dynastyowner.com. If you love sports and you love business and investing, this is the perfect merge of the two. It allows you to play fantasy sports from the owner's box and from the sideline with a coach. You pick your players, you have them for the length of their contracts, you pay them their actual NFL salaries, you manage a salary cap, you manage the everyday business of the team. And you can even sell your team in the future for a profit if teams' values go up. You have complete control of your team from drafting, taking up their contracts, making trades with other teams, making all these things happen, and you can trade draft picks. Dynasty dollars are in-game currency, and players, not just player-to-player trades. This is the most realistic approach to fantasy sports and sports ownership. DynastyOwner.com. Sign up today and use our code EM10, EM10 for a discount. Thank you very much. Don't forget to subscribe to this channel. Check out our video on our 8-pillar process to understand how we look at individual stocks and figure out which ones are best for our value investing approach.